Chapter 1. Investing in the Stock Market. Basics of stocks. What are stocks? Stock is a stake of a company's ownership. It is a claim on the assets and liabilities of the firm. The more stocks you have, the greater the company's ownership share. Inventory, equity, and shares, all of these mean the same thing. Being a stock's owner. You are one of the shareholders if you own a stock in a company, also called a stockholder. This implies that you have a right, even if a very small share, of everything that the company owns. For that, you are entitled to the company's profits and voting rights for it. However, being a shareholder does not mean that you have a say in how the company will be operated. In electing the board of directors at annual meetings, it only entitles you to one vote per share. You are issued a stock certificate as confirmation of your stock ownership. It is held electronically at this age, not in paper, otherwise known as street name holding shares. In the past, when the stock owner had to sell his share, he had to take the certificate physically to the brokerage. Now one can only make a phone call or use a computer. The electronic edition, in effect, makes shares simpler to exchange. The management of the company intends to boost the company's worth. If not, then at least in principle shareholders will vote to have the management replaced. In fact, individual investors do not have sufficient shares to have such a big impact on the business. The ones who make the decisions are very big institutional investors and billionaires. As a shareholder, not being able to make decisions is not a big deal. After all, the idea is for someone else to make money. What is necessary is to get a portion of the income of the company and a claim on properties. Often these gains are referred to as dividends. That translates loosely to more shares equals more benefit. The claim for assets only becomes important if a business goes bankrupt. If it is a liquidation case, once all the creditors have been compensated, you get paid. Limited liability is another significant stock element. You do not have any liability if a corporation is unable to pay its debts. Partnerships, on the other hand, are structured so that creditors will come after the partners if the partner goes bankrupt, the shareholders. Therefore, buying a stock means losing only the value of your investment, but not your private properties. Equity and debt. What is the intention of stock issuance? Why are founders expected to sell shares to thousands of people they don't know? This is because of the need to raise funds for the company. By borrowing or selling part of the business, they may do this. The corporation either borrows from a bank or issues bonds in order to borrow. Such strategies are called debt financing. Stock issuance is called funding of equity. The company would not have to pay back the money or pay interest payments when issuing stocks. Shareholders just expect to gain more from their shares than what they have paid for. The initial public offering, or IPO, is the first sale by a private company of the shares issued. We now have an understanding of a business that finances through debt and one that finances through equity. The former, along with interest payments, guarantees the return of your income. Previously stated, by becoming an investor, you bear the danger of a company's demise. If the business goes bankrupt and liquidates, once the bondholders have been compensated, you do not get any money. This is called absolute precedence. Shareholders gain a lot if the business is good, and vice versa. Risk. There is no warranty for individual stocks. Other businesses may pay dividends, while others may not. Without dividends, only through a stock's appreciation in the free market can investors make money. It is not all negative to take on a chance. A higher risk could signal a higher return on investment. This is why stocks have done better historically than bonds or saving plans. Stock investments have an average return of 10 to 12% on a long-term basis. Investing in the stock market. It can be a daunting process if you've never invested in the stock market before. Stocks are not like savings accounts, money market funds, or deposit certificates, in that their key value can both increase and decrease. You can lose much or even all of your investment capital if you do not have adequate knowledge of investing or emotional control. That's why it's so important to learn the fundamentals of how to invest in stocks. Step 1. Determine the goals. You first have to make sure that your overall financial condition is in a position to handle the new operation before you get into investing of any sort. From revenue to debt, your household budget, your financial luggage contains everything. With our favorite personal finance app, Personal Capital, you can organize your finances for free. And if you link up to $100,000 of investable assets with personal money, a licensed fiduciary advisor can get a free portfolio analysis. This value appraisal of $799 is a perfect way to find out whether you are on track to achieve your financial goals, as well as get tailored for financial guidance, such as how to lower your taxes and ensure that your retirement target is met. Specific considerations include employment. Ensure that both your work and your income are sufficiently healthy to allow you to start investing. Debt. If you have a large amount of unpaid credit, before you start saving, you might want to pay off any debt. You should never spend money you can't afford to lose, because if you have too much debt, that's the situation you'll be in. Family situation. You will need all your available income to assist with the new arrival if you have just welcomed a baby into the world. Family conditions should be secure before you start investing. You should have some room in your budget for your household budget to funnel cash into your investment projects. It's also beneficial to understand your priorities and ask yourself why you want to start investing. Are these your retirement savings accounts? Is this capital more like 5 to 6 years away for a shorter-term objective? Is somebody else going to have access to this money? As the starting point of your investment, using these 3 questions will help shape the decisions you need to make next, and they don't need any stock market awareness. There are extremely personal questions that need to be answered by an investor for themselves. There is no correct answer, only the right answer for your life and your objectives. For the longer term, investing makes the most sense. In general, you don't want to spend the capital you need in less than 5 years, because in a downturn, there is a chance of losing the money. Step 2. Put some cash on the side. You should first get some put away before you pull all of your cash at risk, which would not be subject to any risk whatsoever. The minimum should be a cash balance equivalent to at least 3 months' living expenses, and it should sit in nothing more volatile than deposit certificates or money market accounts. The cash reserve's purpose is twofold. In the case of a temporary income disruption or other financial emergencies, serve as an emergency fund. If your risk-type investments take a sudden dive, prevent you from panicking. Step 3. Open a retirement account. The safest place to start saving is in a savings account, once you have a well-stocked emergency fund set up. If there is no workplace plan, this retirement account can be a 401k plan, or its equivalent, through the employer, or an individual retirement account, commonly called an IRA. Since they reflect long-term savings, retirement accounts are an excellent start. In addition, they are tax-sheltered and can yield immediate tax benefits and are usually financed by deductions from payrolls. They can be thought of as patient capital, where you have decades to accumulate your money and expand it. One of the best aspects of a retirement account is that once you're ready to do so, you can build up capital in the portfolio without actually spending any money. Until you feel comfortable adding stocks and funds to the portfolio, you should keep it all in a money market account inside the plan. Here's a short overview of the most popular pension accounts that you could come across: 401k, 403b, Roth IRA, Traditional IRA, SEP IRA. These accounts have a lot of differences, and you might not be able to open and finance all of them. Try using the Retirement Manager with Personal Resources if you want to get specialist assistance. We think it's one of the best calculators out there for retirement, paid or free. Employer-sponsored retirement accounts. In general, finding out whether your job has a workplace-sponsored retirement plan, such as a 401k or a 403b, will be your first move. Before you can start contributing to the scheme, individual businesses can have limitations on what you can invest in or how long you have to do work at the organization. These accounts, which also come with an employer match, which is the same sum of money or a percentage of what you add to the account, is added by an employer. For your savings, it's free money. Reach out to see what retirement options are available to your HR department. Upon signing up for one, get the ball rolling, and feel free to ask HR a lot of questions about how the strategy works for our brand new investors. When you decide to spend money on it, you want to learn as much as you can about your strategy. Individual retirement accounts, or IRAs. You will open an IRA for yourself after you sign up for a workplace retirement plan. IRA stands for Individual Retirement Account. Anyone over 18 can open one for themselves with money. In general, IRAs are not attached to an employer, making them valuable for freelancers and part-time workers. For IRAs, there are several choices, and they each have different details. For instance, for a Roth IRA, there are income limits. Before you open all of them, do some research about which account is right for you. You can start with our article that compares different accounts for retirement. Step 4. Start investing with low-cost online service. It's time to start saving for your non-retirement investing needs once you have a retirement plan set up and running. Using a robo-advisor. You might be happier using a robo-advisor if you're not the sort of person who wants to DIY their investment accounts. To help build the optimal portfolio combination for your needs and risk tolerance, robo-advisors use algorithms, usually by investing in exchange-traded funds. You don't normally get to choose individual stocks or funds. The robo-advisor does it all for you. You can set it and forget it for real. For new investors, Betterment is an excellent robo-advisor choice because there is no minimum initial deposit requirement. You can create the fund with periodic contributions as low as $100 per month. Its charges are among the lowest in the market. We really like Vanguard Digital Advisor very much. It has some of the biggest exchange-traded funds worldwide. With their robo-advice service, you can directly invest in them for an annual advisory fee of about 0.15%, one of the cheapest in the industry. The only downside is that to get started, you have to spend a minimum of $3,000. One disadvantage of a robo-advisor like Betterment is that there is little investment in the account. You purchase either a basket of ETFs related to stocks or a basket of ETFs related to bonds. However, when you first start out, this is not a problem. Still, you will need to look for a full-service broker to meet your needs when you are prepared to spread your capital across the investment universe, and particularly into individual stocks. You can use a service like Paladin Registry if you want to find a financial planner that can not only help you invest, but also help you prepare for the future. This service allows you to find a licensed advisor who, in your best interest, is legally bound to act. Using an online stockbroker. Online stockbrokers let you do the trading yourself, as opposed to hands-off robo-advisors. That means, on your own, reading, picking, purchasing, and selling stocks, options, funds, and etc. Merrill Edge is a great stockbroker choice for beginners. As a Bank of America subsidiary, by getting your bank and investment account in one location, you can simplify your finances. Stock trades are commission-free, like most stockbrokers, but you may have to pay a small charge on more sophisticated trades, such as options and mutual funds. There are several account options provided by Merrill Edge, including IRAs, 529s, and taxable investment accounts. Step 5. Start with mutual or exchange-traded funds. You'll be much better off with mutual funds and ETFs when you start saving than plunging straight into stocks. Funds are handled professionally, and this will eliminate the stock collection pressure from your desk. All you need to do is opening an account with one of the many available commission-free ETF trading apps. Determine how much money you want to put into a fund or group of funds, and then for the rest of your life, you're free to get on. One of the benefits of mutual funds is that you do not need to think about diversification either. Diversification would be already built into the portfolio, as each fund holds multiple stocks. Step 6. Stay with index funds. Stick with index funds in order to make mutual fund investing even more hassle-free. Index funds that follow the Standard & Poor's 500 index, for example, are invested in the broad market, so the investment results will exactly track the index. In an index fund, while you will never outperform the market, you will never underperform it either. This is as it should be as a new investor. To control both the index funds and ETFs, Wealthfront is an exceptional robo-advisor. Step 6. Use averaging dollar cost. Gradually, rather than all at once into your investment positions. For instance, you can make periodic contributions of, say, $100 per month into the fund, rather than investing $5,000 in a single index fund. You eliminate the option of buying at the top of the market by doing this. Instead, at all different times and regularly, you are investing into the fund. This also removes the issue of when, as in when to invest in a given security or fund. Dollar cost averaging fits nicely for payroll contributions and is a natural match for mutual funds and ETFs, much better for you. Step 8. Get any investment practice. We should have made this the number 3 move, with the purpose that, before doing something at all, you have some understanding of investing. Fortunately, with the help of index funds and dollar cost averages, mutual funds and ETFs reduce the need. You should instantly begin saving, even if you're a beginner. But you will need to read everything you can about investing before you do, if you want to venture beyond funds, payroll deductions, and dollar cost averaging, and into owning individual stocks. You should use this opportunity to inform yourself about the game of investing as you collect cash for investments and pile them into mutual funds and ETFs. Read books, listen to CDs, read the Wall Street Journal, and take a course or two at a brokerage company, or even at a community college. Enter investing groups and visit investment websites such as investorjunkie.com on a regular basis. Another outstanding resource and potential investment site to use is Vanguard. For someone who can spend at least $50,000 to begin with, they currently offer a personal advisory service. Come up with a plan of investment that works for you. Are you a risk-averse, cautious investor? Or are you going to try and beat the market aggressively? Are you investing $5 and saving for the long term? Or are you investing $1 million and trying for generations to secure wealth? You'll need to surround yourself with investing experts and learn all that you can to become a good investor. Before you begin investing with real money, the idea is to become fluent in investments. Another choice is to work with an online broker that provides virtual trading, that is, just trading paper securities. This offers you a valuable opportunity before finally spending your own money to test investment strategies. Several online brokers, including TD Ameritrade and Webull, offer this service. The better you understand before you start investing, the lower the amount of risk you can take. Step 9. Invest gradually in individual stocks. When you eventually feel secure enough to start investing in inventories, make sure you gradually do it. In general, when investing in individual stocks, you do not have the dollar cost averaging function, so you will have to build the technique to do this on a gradual basis. As you would already have substantial options in mutual funds and ETFs, as you work towards building a portfolio, you can start investing in stocks one at a time. Overexposure to a single stock can be avoided by fund positions, as long as you can ensure that your stock position constitutes just a small minority of your overall portfolio, generally 10% or less. Never overload a single inventory. Take a minimal position in one stock when you start out, normally 100 shares, to take advantage of the best pricing, and then switch into another stock. Repeat the process until, in addition to your mutual funds and ETFs, you have multiple stock positions in your portfolio. Step 10. Don't forget, diversify. You have already taken a huge step towards diversifying your portfolio if you've set up a cash reserve, a retirement plan, and an investment account, and have started stocking retirement and investment across with mutual funds and ETFs. The inclusion of individual inventories would further diversify your stocks of cash and funds, but you will also need to distribute your resources between different equity sectors when constructing your portfolio. For example, you would choose to have some of your portfolio invested in shares, growth and income funds, and foreign funds, depending on your age and risk tolerance. Among your individual stock holdings, you might also want to consider high dividend stocks. Income-earning securities appear to be less volatile, especially in bear markets, than pure growth stocks. You'll want to build a balance between your growth assets and your holdings of income or growth and revenue. A good management firm, such as Fisher Investments, will assist you to ensure your investment account's proper diversification and allocation. Why do you need to start investing now? Numbers don't lie, and this is the truth of the matter. The faster you start investing, the better off you're likely to be. The longer you keep investing your money, the more time it has to expand. By the time they withdraw capital from the market, older investors have a higher chance of seeing a more positive net return on their assets. Take these steps, and you will have the basic basis to help you begin investing in stocks. Just remember that investing is a process, not a destination, so you need to learn and experiment on an ongoing basis. How to invest in stocks. An excellent way to build capital is to invest in stocks. For long-term investors, particularly during times of market turmoil, stocks are a safe investment. A decline in the stock market simply means that many stocks are on sale. One of the easiest ways to start investing in the stock market for beginners is to position money in an online investment account, which can then be used to purchase stock shares or stock mutual funds. With several investment accounts for the price of a single share, you can start investing. 1. Decide how you would like to invest in stocks. There are many ways to view investing in stocks. Choose the option that best reflects how you want to invest and how you want to be hands-on in choosing and selecting the stocks in which you invest. 2. Select an investment account. Generally speaking, you need an investment account to invest in stocks. This typically means a brokerage account for the hands-on forms. Opening an account with a robo-advisor is a sensible choice for those who would like a little support. Momentarily, we will break down all procedures. A significant point: both brokers and robo-advisors allow you very little money to open an account. 3. Know the difference between stocks and mutual funds from stocks. Moving along the DIY route? Don't be afraid. Investing in stocks doesn't have to be complex. Stock market investments for most individuals means choosing between these two forms of investment: mutual funds or exchange-traded funds in reserve. In a single transaction, mutual funds let you buy small pieces of several different stocks. Index funds and ETFs are a form of mutual fund that follows an index. A Standard & Poor's 500 fund, for example, replicates the index by purchasing the stock of the companies in it. You also own small parts of each of those businesses when you invest in a fund. To build a diversified portfolio, you can bring multiple funds together. Notice that stock mutual funds are often referred to as equity mutual funds as well. Individual stocks. You can buy a single share or a few shares as a way to dip your toe into the stock trading waters if you're after a particular company. It is feasible to create a diversified portfolio out of several individual stocks, but it requires a large investment. Stock mutual funds have the advantage of being inherently diversified, which reduces your risk. For the overwhelming majority of investors, particularly those who invest their retirement savings, the clear option is a portfolio comprised mainly of mutual funds. But as some individual stocks might, mutual funds are unlikely to grow in meteoric fashion. The advantage of individual stocks is that a wise choice will pay off handsomely, but the chances are extremely slim that any individual stock would make you wealthy. 4. Set a budget for your investment in stocks. In this stage of the process, new investors often have two questions. In order to start investing in stocks, how much money do I need? The amount of cash you need to purchase an individual stock depends on how costly the shares are. Share prices can vary from only a few dollars to a few $1,000s. An exchange-traded fund, or ETF, could be your best bet if you want mutual funds and have a limited budget. Mutual funds also have a minimum of $1,000 or more, but ETFs trade like a portfolio, meaning you buy them at a share price, less than $100 in some cases. How much money am I expected to invest in stocks? If you mean by means of funds, have we mentioned that most financial advisors prefer this? You can allocate a fairly large portion of your portfolio, especially if you have a long time horizon, to stock funds. A 30-year-old retirement investor could have 80% of his or her mutual fund portfolio. The remainder would be in bond funds. Another story is individual stocks. Holding these in a limited portion of your investment portfolio is a general rule of thumb. 5. Concentrate on the long term. Investing in stocks is riddled with nuanced strategies, yet some of the most active investors have done nothing more than stick to the fundamentals. That typically means using funds for the bulk of your portfolio. Warren Buffett has famously said that a low-cost S&P 500 index fund is the best investment that most Americans can make, and only if you believe in the long-term growth prospects of the business, preferring individual stocks. After you start investing in stocks or mutual funds, the right thing to do might be the hardest. Don't look at them. It's nice to stop the practice of compulsively checking out how your stocks are doing many times a day, every day, unless you are trying to beat the odds and excel in day trading. 6. Manage your stocks portfolio. Although thinking about daily fluctuations will not do much for the well-being of your portfolio or your own, there will certainly be periods when you will have to check on your stocks or other investments. If you take the previously mentioned measures over time to purchase mutual funds and individual stocks, you may want to review your portfolio a few times a year to ensure that it is still in line with your investment goals. A few things to consider. You may want to switch some of your equity assets over to more conservative fixed income investments if you're approaching retirement. If your portfolio in one sector or industry is too heavily weighted, consider purchasing stocks or funds in another sector to create further diversification. Finally, pay attention to the diversification of geography too. Vanguard suggests that as many as 40% of the stocks in your portfolio be made up of foreign stocks. To get this exposure, you can buy foreign stock mutual funds. How does the stock market operate? As a secure and controlled auction house where buyers and sellers can negotiate rates and exchange investments, you can think of a stock market. A stock market is a network of sorts of exchanges, and on an exchange, businesses list securities. Investors then buy and purchase shares and sell them to each other. Many of the investors are big funds that control lots of assets, but through a broker like Acorns, individuals can buy and sell. You may have seen scenes in movies or on TV shows where buyers and sellers are fervently screaming, "Buy, buy, buy" on the floor of the New York Stock Exchange, or "Selling, selling, selling." While the stock market has traditionally been a physical marketplace, such as the New York Stock Exchange and the American Stock Exchange, through a series of trading platforms, shares are more widely exchanged these days. These days, almost all the transactions are made online, not in person. The public listing itself is not a prerequisite for stock sales, although many stocks are listed on the exchange. A little later on, we'll go into private stocks and over-the-counter markets. Major stock exchanges. These are the real markets where company shares are traded when you hear the word stock exchanges. If anyone refers to the U.S. stock market, they also speak about either the New York Stock Exchange on Wall Street or the NASDAQ, which stands for National Association of Securities Dealers Automated Quotations. One of the big indices, such as the Dow Jones Industrial Average or the S&P 500 Index, may also be addressed. In terms of market capitalization, meaning the value of a publicly traded company, the New York Stock Exchange and NASDAQ are the main markets and are determined by multiplying the total number of shares by their most recent share price. The world's top 5 stock markets are the New York Stock Exchange, NASDAQ, the Tokyo Stock Exchange, the Shanghai Stock Exchange, and the Hong Kong Stock Exchange. Why the economy influences the stock market. There are several factors influencing how and whether the stock market is going up or down. The political climate, social factors, interest rates, patterns and improvements in what investors want. And how is the stock market influenced by the economy? If the general public feels as if the economy will soon take a turn for the worse, since bonds and treasuries provide a safer return, they prefer to sell stock. On the other side, they prefer to buy stock when people feel secure and positive about the economy, taking more risk for greater reward. From a high-level approach, they prefer to buy more stock when individuals feel confident about the economy. They may be more conservative when things are happening in the world to make them feel uncertain, and will gravitate towards lower-risk investments, such as bonds and treasury bills. What is a stock? A stock is literally a share of ownership in a business or company, at the most basic level. 2 types of stock exist: private and public. Public inventories. A public company is one that issues inventory that can be purchased and sold on stock markets by the general public. These public stocks are purchased by shareholders, who are part of the general public, rather than stocks held by those in the company. When you hear about a business going public, it means it's being put on the stock exchange. It's doing what is known as an initial public offering, or an IPO. The business that is going public will make a certain number of shares available for a certain amount, along with an underwriter who is an investment bank. For example, in early May 2019, when Beyond Meat, the stock symbol for which is BYND, went public, it was priced at $25 a share, with an implied $1.46 billion market valuation. Private stocks. The general public doesn't have access to them when it comes to private stocks. Generally, these shares are small in number. The stock is generally owned by a limited number of individuals and is not publicly traded on any market. Only workers and internal investors, such as managers, may be given shares. The grocery store chain Publix, for instance, is a privately held business. Only the shop associates and the board of directors are eligible for shares. The public stock forms. Once a business has gone public and individuals have bought initial shares, as an investor, there are a few ways you can make money. Common stock. Common stock is the kind of stock individuals think of when they refer to stocks. It's the most fundamental way to own a company. You have a proportionate interest in the company if you own a share of a common share, which depends on how many shares you own. In one of 2 ways you can earn money: by cash dividends. When the company is profitable and revenue is greater than its expenditures, these may be offered by businesses. A corporation is able to pay dividends to its shareholders when this occurs. By the market price of a share. The shareholders will make cash by selling shares as the price goes up. You generally have voting rights when you own common stock. You can vote, among other issues, on who is elected to the board of directors of a corporation. Depending on how many shares you own, how many votes you will cast. Either by proxy or attending an annual conference, you may vote. Preferred stock. You obtain a fixed dividend per share with preferred stock that a business has to allocate before a payout to owners of the common stock occurs. You're promised a dividend for as long as you keep it if you're a shareholder in a preferred stock. A downside to owning preferred stock is that voting rights are seldom obtained. Notice that the dividend is paid at a fixed rate, and the form of fixed income is preferred stock. Extra profits from the stock other than the dividend is seldom paid out by a business selling preferred stock. You might be drawn to preferred stock if you want a more stable source of revenue. The stock classes. It refers to how many voting rights a shareholder has when you reference a Class A stock versus a Class B or Class C stock. Class A stock shareholders have more say than Class B stock shareholders. Here's the thing. A corporation can create different stock classes, and with each of the different classes, they can also decide how much voting rights you have. In contrast to their Class A stock, which is the common stock, a corporation may also decide how much the stock is worth. The players in the business. The market participants who buy and sell stocks can depend on the stock market to which you are referring. In fact, there are 3 distinct types of markets where firms, investors, and their brokers can buy and sell stock. In each one of these, let's run through the market participants. Primary market. The primary market is where businesses sell shares of stock directly to buyers. This occurs when a company goes public in an IPO, but it may also occur if the company later chooses to raise more capital in a new round of financing by making more shares available at a given price. Usually at this stage, businesses do not sell to individual buyers. They also sell assets to big institutional investors, such as pension boards, hedge funds, and mutual funds, managing money for large groups of individuals. The selling appears to go reasonably quickly if these funds purchase hundreds or thousands of shares. For businesses that want the fast influx of cash that can come with a stock offering, this is preferable. In order for the average public investor to get involved, you need to go down a stage and speak about the secondary sector. Secondary market. The secondary market is only between buyers, and corporations are not interested. Hedge funds, pensions, and other institutional investors are also interested, but this is also where individual investors are willing to purchase stock, whether it means purchasing individual company shares or a combination of them in an exchange fund. It's a secondary market, where without investing hundreds of thousands of dollars on shares, people can make investments. Usually the stock price is publicly traded on an exchange, dependent on individuals purchasing and selling it, but it doesn't have to be. Over-the-counter markets. In order to be eligible for listing, major stock exchanges such as the New York Stock Exchange, NASDAQ, and London stock exchanges have certain criteria that businesses must meet. These include the public reporting of certain financial reports and outlook estimates, as well as the need to retain a certain share price. They have the option to go for an over-the-counter stock sale if businesses are unable to meet these requirements. Instead of being publicly traded on an exchange, in places like a company website, you usually find investor details. There is no public price when you buy and sell over-the-counter stocks, and each trade is completed between individuals. This is when it comes to the idea of market makers. One person may be willing to buy from you at a certain price if you're trying to sell stock, and if you're looking to buy from them, that's a different price. Brokers and others working as market makers make the difference between these bids and ask for rates to make money. The downside of over-the-counter markets is that public rates are not set by everyone, so the system is not as open. You have to trust who you deal with, and you have to be mindful that they may be operating on knowledge that you don't have. Why stocks go up and down. There are a host of underlying variables that can influence whether a stock is going up or down. But the simple law of supply and demand is the most fundamental, rudimentary notion. If there is a strong demand for a specific stock, and there are few people willing to sell that stock, the price goes up. Conversely, if many sellers have low demand, it pushes down the price of a stock. Factors driving demand boil down to knowledge and the success and earnings of a company, but it can also be partially attributed to speculation. How investors view and feel about a company's profitability, for example, may decide whether they are buying or selling. If a business is perceived to have a highly anticipated new product coming out, its stock will rise. Companies, on the other hand, may also be adversely affected out of their reach by economic factors. For example, in many states linked to COVID-19, stay-at-home orders caused a drop in oil supplies because people who did not go anywhere caused gas demand to crater, which contributed to an oversupply of oil. People have rushed to shield their money as a result of COVID-19. Though there are many cases for stocks to go up and down on their own, general market dynamics can often help drive them in one direction or another. How to read stocks. Knowing how to read stocks is an integral part of understanding how the stock market operates. But you'll see a string of abbreviations and numbers if you've ever tried to read a stock table. What are they all signifying? Let's break them down. Each business has a trading symbol, usually abbreviated to, for example, the symbol of Apple Inc. is AAPL. The current price of a share is the first number you'll normally see on every major financial news source with a stock trader. If you're looking at a stock table, the year-to-date, or YTD shift, generally includes it. This is generally expressed as a percentage and indicates how, since the beginning of the year, the price of a certain stock has changed. Over the last 52 weeks, you will also notice the high and low prices and the sum of the dividend. The price of the last trading company and also the net change, which is the change between the closing price of the current day in relation to the closing price of the previous trading day, can also be included in the market table or stock quote. What's more, in a variety of ways, you can study a business that is traded on the stock market. To see how the stock price has improved over various periods of time, go to a big financial journal. Hunt down the Securities and Exchange Commission corporate filings from the SEC. Find more information on Morningstar or Bloomberg about a business. Using a candlesticks map. There are a variety of ways you can use existing data to calculate this while trying to find out how a specific stock is doing. A typical line graph, for example, shows the ups and downs of the output of a stock. And there's a map of candlesticks. Often known as a Japanese candlestick map, it delves into greater detail by showing you over a period of time the real purchase and selling trends. This is how it works. One candle on the market represents one day. For a given day, each candle or package includes 4 prices: open and close, high and low. The top and bottom ends reflect how much the stock shifted between where it opened and where it closed, whether you're looking at a candlestick or box itself, aka the candle or body. You might see upward motion depicted as a green box, whereas downward motion is similar to a red box. As for outside the box, aka the wicks, for that particular stock, the vertical line equates to the high and the low prices of a given day. This is the trading range of the stock for the day. Since a candlestick chart is jam-packed with data, it is typically used to represent shorter time periods. And while you are shown trends and how a stock moves and performs on a candlestick map, it doesn't tell you why a stock moved the way it did. Day traders use these charts' movements to try to identify trends so that they can select stocks to purchase for a short-term investment when attempting to sell before the stock goes back down. For such an investment strategy, the general issue is that it is difficult to get the timing of the demand correct. Additionally, if you keep the stock for less than a year, the capital gains tax rate on any income is higher. It's important to remember that, while it has its ups and downs, the S&P 500 index averages 7% growth after inflation if you were to invest in the stock market over the course of several years. Many investors tend to take a long-term view of the stock market for this purpose. How do you invest in the market for stocks? In the stock market, there are quite a few ways that you can invest. It relies on a variety of things: your time period, target date, level of comfort, and risk tolerance. For example, if you have more time to invest, we're talking about 30 plus years, and have a higher degree of comfort with risk, your strategy would be on the aggressive side. On the flip side, your mindset will change to conservative if you're older and have less time to invest in the stock market and aren't as comfortable with risk. Here are several kinds of savings accounts and investment funds to invest in. 401k. This is a benefit funded by an employer and is a fixed contribution. A defined contribution means regular contributions to the plan are made by the employer, the employee, or both. Only if your company provides such a package will you open a 401k account. IRA. Although you have to go to open a 401k account via an employer, an IRA is a form of retirement account that you can open on your own. Note that IRAs are not an investment for your savings, but a form of account. Roth IRAs and conventional IRAs are the two major kinds. The biggest difference is that you're going to be charged. With a Roth IRA, you contribute dollars after tax. The money in your account is tax-free, and you will not owe any distribution taxes. You bring in pre-tax dollars with a traditional IRA, which decreases your taxable income in the year you make your contributions. However, when it is time to take your money out of your savings, you will owe taxes. Buying individual stocks. You will need to consider industry trends and keep abreast of news about the businesses in which you buy stocks. You will need to purchase these, online or otherwise, by stock brokers. Mutual funds. A mutual fund is an investment scheme that pools funds to purchase assets from several investors. The aim is to invest in sales or growth. Mutual funds are professionally managed, and most invest in a diversified portfolio consisting of several asset types, such as stocks, bonds, and other securities. Index funds and ETFs. You would get an exchange-traded fund if a stock and a mutual fund had a boy, an ETF. ETFs hold a portfolio of securities, such as stocks, bonds, commodities, and currencies, much like mutual funds, only trading just like stocks. As for how their values are determined, they are determined by the market forces and exchanged on a stock exchange during the business day. For a starting investor who isn't sure what to buy, these can be good. Services like Acorns will allow you to purchase ETFs and funds from indexes. Set your budget. As they say, money is needed to make money. How do you know if you're willing to invest? For one thing, in case an emergency comes up, you should have enough to cover your monthly expenditures and bills, have some savings, and have your loan repayments under control. Next, find out how much you can afford for your stock investments to budget fairly. Ideally, a sound investment plan involves being able to invest for a long period of time on a continuous basis, even if it implies starting small or rising the total of your contribution to an employer-sponsored 401k. There are a handful of online platforms and applications these days where you can start investing in the stock market for just $5. The crucial thing now is to get the ball to roll. That way, if you have more money to spend, you'll have the inroads carved out and the habits established. Pursuing your interests. Consider businesses and sectors in which you have a natural interest if you want to go the active investment path. It'll be easier to know what's going on with your finances if you already have a finger on the pulse of these particular realms. As an active investor, You will need to stay on top of what's going on across the globe, market trends, and economic and political developments that could influence your investment's efficiency. You may use reports from stock consulting companies or stock brokerages to remain in the know and subscribe to newsletters. While there is no way to predict the future, the more research you do and the more experience you have, the better position you will be to make educated choices. Are you a passive investor anymore? If so, you will most likely concentrate on investing in stocks that can provide returns in the long term, such as mutual funds and ETFs. You'll want to try to balance a large market index with this approach. This implies diversification, yields, and low fees and expenses. Now that you understand what the stock market is and how it works, by getting started you will hopefully not feel as confused or as intimidated. Note, the financial state of everyone is different. If you're uncertain if a specific investment plan is right for you, it's best to focus on financial advisors' guidance that will educate you on your personal financial situation. Chapter 2: Trading. Every year, millions of neophytes try their hand at the market casino, but most walk away a little poorer and much wiser, never having achieved their full potential. There's one thing in common for the majority of those who fail. They have not mastered the basic skills needed to tip the odds in their favor. However, it is possible to be on the road to growing one's chances of success if one takes ample time to study them. World markets draw speculative capital like moths to a flame. Without knowing why rates shift higher or lower, most people throw money at securities. Instead, they are chasing hot tips, making binary bets, and sitting at the feet of gurus, encouraging them to make pointless buy and sell choices. A safer route is to learn how to trade with skill and authority in the markets. Start with a self-examination that explores your relationship with money closely. Do you see life as a challenge, with the difficult effort needed to earn every dollar? Do you think that in other life endeavors, personal magnetism can draw consumer wealth to you in the same way it does? More ominously, have you lost money from other activities on a daily basis, and do you hope that the financial markets will treat you more kindly? Whatever the value system, through gains and losses, the economy is likely to reinforce the internal perception again. Hard work and charisma both promote financial success, but in the trading game, losers in other walks of life are likely to become losers. If this sounds like you, don't worry. Alternatively, take the self-help path and learn about the link between cash and self-worth. You can embark on learning trading once you get your head straight, and start with these 5 simple steps. 1. Open a trading account. I'm sorry if we seem to be stating the obvious, but you never know. Find a good online stockbroker and open a stock brokerage account. Remember the person who did everything to set up his new machine except to plug it in? And if you already own a personal account, having a professional trading account separate is not a bad idea. Take advantage of the free trading tools and analysis offered exclusively to customers, and become acquainted with the account GUI. Digital trading is provided by many brokers. 2. Learn to read. A market crash course. Financial posts, books on capital markets, tutorials on blogs, and etc. There's a wealth of knowledge out there, and taping a lot of it is inexpensive. It is important not to concentrate too narrowly on a single feature of the trading game. Instead, at this moment, research all market-wise, even ideas and concepts that you don't feel are particularly important. Trading begins a journey that frequently ends up at the starting line at a destination not expected. Your large and comprehensive business history, even though you think you know exactly where you're going right now, will come in handy again and again. For any new trader, here are 5 must-read books. Stock Market Wizards by Jack D. Schwager. Trading for a Living by Dr. Alexander Elder. Technical Analysis of the Financial Markets by John Murphy. Winning on Wall Street by Martin Zweig. The Nature of Risk by Justin Mamus. In your spare time, start to track the market every day. Get up early and learn about price behavior overnight on international markets. A few days ago, U.S. traders didn't have to control global markets, but because of the rapid growth of electronic trading and derivative instruments that bind stock, forex, and bond markets around the world, that's all changed. For new investors, news websites such as Yahoo Finance, Google Finance, and CBS Money Watch act as a great resource. You must look no further than the Wall Street Journal and Bloomberg for more sophisticated coverage. 3. Learn analysis. Study the fundamentals of technical analysis and look at price charts in all time frames, thousands of them. You may assume the fundamental analysis provides a safer path to profits because it monitors growth curves and revenue sources. But traders live and die from market activity that diverges dramatically from underlying fundamentals. Do not avoid reading company spreadsheets because those who neglect them give a trading advantage over them. They will not help you survive your first year as a dealer, however. You are now taken into the mystical world of price prediction by your familiarity with charts and technical analysis. Securities may potentially only go higher or lower, facilitating a long side trade or a short sale. Prices can do many other things, in fact, including chopping sideways for weeks at a time, or violently whipsawing in both directions, shaking buyers and sellers out. At this juncture, the time horizon becomes highly important. Capital markets churn out patterns and fractal property trading ranges that produce short-term, intermediate-term, and long-term independent price movements. This means that a long-term uptrend, immediate downtrend, and short-term trading range can be generated by a security or index all at the same time. Many trade opportunities can unfold by interactions between these time periods instead of complicated forecasting. Buying the dip provides a classic example, when it sells off in a lower time, with traders jumping onto a powerful uptrend. Looking at each protection in 3 time frames, beginning with 60-minute, regular, and weekly maps, is the best way to analyze this 3-dimensional playing field. 4. Practice trading. Now it's time to get your feet wet without giving up your confidence in trading. Paper trading, or virtual trading, provides a perfect solution that allows the neophyte to monitor market activity in real time, making purchasing and selling decisions that form the outline of a theoretical record of success. It typically requires the use of a simulator of the stock market that has the look and feel of the results of a real stock exchange. Using various holding periods and techniques, make lots of trades, and then examine the outcomes for apparent flaws. Traders need to twin emotions of greed and fear to coexist peacefully. Trading in paper does not include these feelings, which can only be experienced through real benefit and loss. In fact, this psychological factor pushes more players out of the game for the first year than bad decision-making. As a new trader needs to understand this challenge and fix remaining problems with money and self-worth, the baby goes forward. 5. Other ways to learn and practice trading. Although experience is a good instructor, as you continue your business career, don't forget about additional education. Classes can be helpful whether online or in person, and you can find them at levels ranging from beginner to pro, with guidance on how to interpret the previously mentioned analytical maps, for example. Often conducted by a skilled trader, more advanced seminars may provide useful insight into the overall market and detailed investment strategies. Most concentrate on a particular type of commodity, a specific market feature, or a trading technique. Others may be educational, and others may be more like seminars, where you deliberately take positions, evaluate techniques for entry and exit, and other exercises, often with a simulator. It can be both informative and beneficial to pay for study and review. Some investors can find it more valuable to watch or study market practitioners than to attempt to apply newly learned lessons themselves. Manage and prosper. You need to discuss role and risk management once you're up and running with real money. Each place has a holding period and technical requirements that favor profit and loss goals, which, when achieved, require your timely exit. Today, when you hold 3 to 5 positions at a time, consider the mental and logistic demands, with some going in your favor, while others charge in the opposite direction. Fortunately, as long as you do not overload yourself with too much data, there's plenty of time to learn all aspects of trade management. If you've not already done so, now is the time to start a daily journal that records all your expenses, including the risk-taking factors, as well as the holding periods and final profit or loss estimates. This diary of events and observations sets the basis for a trading edge that will put an end to your inexperienced status and allow you to regularly take money out of the market. Chapter 3. Cash Flow. As stated in earning announcements, cash flow is the amount of money coming into and going out of the accounts of a company. It may apply to the whole organization or a particular project. Some traders use cash flow as a way to judge the financial foundations of a company. If there is a large amount of cash coming in, reinvesting in the company is more available. Since it is not subject to accounting laws, cash flow can be easier to compare between businesses. Cash flow is not inherently a measure of a profitable business, but it shows its liquidity. Total cash flow is estimated to include a difference in the cash balance by deducting the total expenses and adding revenue over a period of time. However, there are also other kinds of cash flow, depending on which part of the cash flow of an organization is being measured. On a per-share basis, cash flow per share is the after-tax earnings plus depreciation that serves as a measure of the financial strength of the company. Several financial analysts rely more on cash flow per share than on earnings per share or EPS. While earnings per share may be manipulated, it is more difficult to modify the cash flow per share, resulting in what could be a more precise value of a specific business model's strength and sustainability. Understanding cash flow per share. Cash flow per share is measured as a measure representing the amount of cash a company receives based on the net profits of a company with the depreciation and amortization costs applied back. Since the depreciation and amortization related costs are not simply cash expenses, adding them back prevents the cash flow figures of the companies from being artificially deflated. The formula to calculate per share cash flow is as follows. Cash flow per share equals, in parentheses, the operating cash flow, the preferred dividends, divided by the outstanding common shares. Cash flow and free cash flow per share. Free cash flow, or FCF, is similar to cash flow per share in that it increases the effort to keep the cash flow of a company from being artificially deflated. Costs associated with one-time capital expenses, dividend distributions, and other non-recurring or irregular operations are included in the free cash flow estimate. As compared to spreading them out over time, the company pays for these expenses at the time they arise. Free cash flow offers details on the amount of cash a corporation currently earns during the time under analysis. Since they see free cash flow as offering a more reliable snapshot of the finances and viability of a business, some investors tend to measure a stock instead of its earnings per share on its free cash flow per share. Earnings per share versus cash flow per share. The earnings per share of a company is the portion of its profit that is assigned to each outstanding common stock share. Earnings per share, like cash flow per share, act as a measure of the profitability of a company. Earnings per share are determined by dividing the profit of a company, or net profits, by the number of shares outstanding. As depreciation, amortization, one-time costs, and other irregular expenses are usually subtracted from the net profits of a company, it is possible to artificially deflate the result of the measurement of earnings per share. In addition, earnings per share can be falsely inflated with earnings other than cash from sources. Non-cash profits and revenue may include purchases of products or services on credit provided by the selling business purchased by the seller, and may also include the appreciation of any assets or sales of equipment. Since the cash flow per share takes into account the capacity of a company to produce cash, some view it as a more reliable indicator of the financial position of a company than earnings per share. The net cash of a business generates on a per-share basis is measured by cash flow per share. Chapter 4: Swing Trading. Swing trading is a trading style that seeks to harvest short to medium-term gains over a span of a few days to several weeks in a portfolio or any financial instrument. To look for trading opportunities, swing traders mainly use technical analysis. In addition to analyzing price trends and patterns, these traders can use fundamental analysis. Understanding swing trading. Swing trading usually means holding a position for more than one trading session, either long or short, but generally not more than several weeks or a few months. This is a general time period, since certain trades may last longer than a few months, but they can still be considered swing trades by the trader. During the trading session, swing trades may also take place, but this is an unusual outcome brought on by highly unpredictable conditions. Swing trading's aim is to grab a chunk of a future price change. While some traders with lots of movement are looking for volatile stocks, others may prefer more sedate stocks. Swing trading is the method of determining whether the price of an asset is likely to move next, entering a spot, and then taking a chunk of the benefit if that move materializes in either case. Effective swing traders are only searching for a chunk of the anticipated price change to catch and then move on to the next chance. One of the most common forms of active trading is swing trading, where traders use different forms of technical analysis to search for intermediate-term opportunities. You should be intimately acquainted with technical analysis if you are involved in swing trading. On a risk-to-reward basis, many swing traders analyze trades. They decide where they will join by evaluating the chart of an asset, where they will put a stop-loss, and then predict where they will get out with a benefit. That is a favorable risk-to-reward ratio if they are investing $1 per share on a setup that might fairly yield a $3 benefit. On the other hand, it's not just as favorable to gamble $1 to make $1, or make just 75 cents. Owing to the short-term nature of the transactions, swing traders mainly use technical analysis. That said, to strengthen the analysis, fundamental analysis can be used. If a swing trader sees a bullish setup in a stock, for instance, they may want to check that the asset's fundamentals look favorable or are also improving. On the regular charts, swing traders will also search for openings and will look at 1 hour or 15-minute charts to find an accurate entry, stop loss, and take profit amounts. Pros: this needs less trading time than day trading. By catching the bulk of market fluctuations, it maximizes short-term profit potential. Traders may rely solely on technical analysis, simplifying the process of trading. Cons: trade positions are subject to market risk overnight and over the weekend. Abrupt reversals in the market can lead to significant losses. In pursuit of short-term market movements, swing traders sometimes neglect longer-term patterns. Day trading versus swing trading. The difference between swing trading and day trading is keeping time for positions, generally. Often, swing trading requires at least one overnight hold, while day traders close positions until the market closes. Day trading positions are limited to a single day to generalize, while swing trading requires holding for several days to weeks. The swing trader incurs the unpredictability of overnight risk, such as gaps up or down against the spot by holding overnight. Swing trades are typically conducted with a smaller position size when taking on the overnight risk relative to day trading, assuming the two traders have similarly sized accounts. Usually day traders use greater position sizes and can use a 25% day trading margin. Swing traders also have access to a 50% margin or leverage, This means that for a trade with a current value of $50,000, for example, if the trader is accepted for margin trading, they only need to put up $25,000 in cash. Tactics for swing trading. Multi-day chart trends appear to be searched for by a swing trader. Some of the more common patterns include average moving crossovers, patterns of a cup and handle, patterns of head and shoulders, flags, and triangles. In addition to other indicators, main reversal candlesticks can be used to formulate a solid trading strategy. Each swing trader eventually develops a plan and strategy that gives them an advantage over several trades. This includes searching for trade configurations that appear to lead to predictable fluctuations in the price of an asset. This is not simple, and every time, no plan or setup works. Winning each time is not important with a favorable risk to reward. In order to achieve an overall profit over several trades, the more favorable the risk to reward of a trading strategy, the less times it needs to win. Chapter 5. Stock Trading. Not everyone who buys and sells stocks, at least in the complex language of investment terminology, is a stock trader. Most fall in one of two camps, traders or buyers, depending on how often they buy and sell stocks. The trader's caricature is that of a frenzied Wall Streeter, purchasing and selling during the day in front of monitors and scrolling tickers. On the other hand, investors are usually in it for the long term, buying at regular intervals and selling even less regularly, at least before retirement or not at all. Stock trading on the floor of the New York Stock Exchange is not always what you see, however, and you can get started from the comfort of your sofa. But before you make your first trade, you'd better know what you're doing. What is stock trading? To capitalize on day-to-day market swings, stock traders buy and sell stocks. Instead of buying shares in a blue-chip business for years or even decades, these short-term traders are betting that they can make a few bucks in the next minute, hour, day, or month. Two major forms of stock exchange exist. What an investor who positions 10 or more trades every month does is successful trading. They usually use a strategy that relies heavily on market timing, seeking to take advantage of short-term developments at the level of the business or based on market fluctuations in the coming weeks or months to turn a profit. Day trading is the approach practiced by investors who play hot potato with stocks, purchasing, selling, and closing their stock positions on a single trading day, taking no care of the underlying company's inner workings. Position refers to the volume of a specific stock or fund you own. The day trader's goal is to make a few bucks based on regular price changes in the next few minutes, hours, or days. How to trade stocks. Know that most investors are better served by keeping it straightforward and investing in a diversified mix of low-cost index funds to achieve if you're trying your hand at stock trading for the first time, and this is crucial to long-term outperformance. That said, trading stock logistics comes down to 6 steps. 1. Open an account with a brokerage. Stock trading involves the financing of a brokerage account, a special form of account intended for investments. You can open one with an online broker in a couple of minutes if you don't already have an account. But don't worry, opening an account doesn't mean that you're not spending your cash. Once you're finished, it just gives you the choice to do so. 2. Set a budget for stock trading. Allocating more than 10% of your portfolio to individual stocks will expose your savings to too much uncertainty, even if you find a talent for trading stocks. But this isn't the only risk-managing law. There are other do's and don'ts, including invest just the amount of money to lose that you can afford. Do not use cash that is earmarked for short-term, must-pay costs, such as a down payment or tuition. If you don't yet have a stable emergency fund, ratchet down your 10% and 10 to 15% of your income flow into a retirement savings account. 3. Learn to use limit orders and market orders. When you have your brokerage account and budget in place, the website or trading platform of your online broker can be used to place your stock trades. For order forms, You'll be placed with many choices that determine how your trade goes through. These are the two forms that are the most common. Market order, buy or sell the stock ASAP at the best price possible. And limit order, the stock is only purchased or sold at or better than a particular price you set. The maximum price will be the most you're willing to pay for a purchase order, and the order will only go through if the price of the stock falls to or below that level. 4. Practice with a virtual trading account. There is nothing better than the low-pressure, hands-on experience that investors can obtain through the virtual trading instruments provided by many online stockbrokers. Before putting real dollars on the line, paper trading helps clients to test their trading acumen and build up a track record. Several of the brokers we study, including TD Ameritrade and Interactive Brokers, offer virtual trading. 5. Measure your returns against a reasonable benchmark. For all kinds of investors, not just successful ones, this is important advice. The bottom line aim is to be ahead of the benchmark index for picking stocks. This may be the Standard & Poor's 500 index, often used as a market proxy, the composite index of the NASDAQ for those interested mostly in technology stocks, or other smaller indices consisting of companies based on size, industry, and geography. Measuring outcomes is critical, and if a serious investor is unable to surpass the benchmark, something that even pro investors are struggling to do, then investing in a low-cost index mutual fund or ETF, basically a basket of stocks whose performance closely aligns with that of one of the benchmark's indexes, makes financial sense. 6. Hold your perspective. Being a good investor before anyone else does not entail discovering the next great breakout stock. So have thousands of experienced traders by the time you hear that XYZ stock is primed for a pop, and the opportunity definitely has already been priced into the stock. It might be too late to make a profit from a fast turnaround, but that doesn't mean that the party is too late for you. For years, genuinely large investments continue to have shareholder value, which is a strong reason for treating successful investing as a hobby and not a Hail Mary for fast wealth. How to survive stocks trading. These 4 tips on how to trade stocks will help ensure you do it safely, wherever you fall on the investment trader continuum. 1. Lower risk by steadily constructing positions. With every place, there's no need to cannonball into the deep end. Taking the time to buy helps minimize investor exposure to market volatility via dollar-cost averaging or purchasing in thirds. 2. Ignore hot advice. On the Easy Millions trade website, Wall Street Hotshot 4721 and the people who pay for funded commercials touting sure things stocks are not your friends, advisors, or bona fide Wall Street gurus. They are part of a pump and dump scam in many instances, where crooked people buy buckets of shares in a little-known, thinly traded business, often a penny stock, and hit the internet to hype it up. The crooks take their money, dump their shares, and send the stock careening back to earth as unwitting buyers load up on stocks and push up the price. Don't help them bring their pockets in order. 3. Maintain strong records for the IRS. If you do not use an account that enjoys tax-favored status, such as a 401k or other corporate savings, or a Roth or conventional IRA, it can be difficult to tax investment gains and losses. The IRS applies various rules and tax rates and allows various forms to be submitted for different categories of traders. Another advantage of maintaining good records is that, through a neat technique called tax loss harvesting, loser investments can be used to offset taxes paid on income. 4. Select your broker wisely. You need a broker to exchange stocks, but don't just fall for any broker. Choose one with the terminology and tools that best fit the style and knowledge of investing. Low commissions and quick order execution for time-sensitive trades would be a greater priority for active traders. Investors new to trading can look for a broker who, through educational posts, Online tutorials and in-person seminars can teach them the instruments of trading. The consistency and availability of screening and stock analysis software, on-the-go updates, quick entry of orders, and customer service are other features to consider. No matter what, the time spent on studying the basics of how to study stocks and experience stock trading ups and downs, even though there are more of the latter, is well spent, as long as you enjoy the ride and don't place any money on the line that you can't afford to lose. Chapter 6: Stocks and Shares. There's a fuzzy distinction between stocks and bonds in the capital markets. Generally, both terms are used interchangeably in American English to refer to financial equities, especially to shares denoting ownership in a public corporation. These were called stock certificates in the good old days of paper transactions. The distinction between the two words nowadays has more to do with syntax and is derived from the context they are used in. Similar terminology. Of the two, the more common generic word stocks is. It is also used to define a slice of one or more of the company's ownership. In addition, shares has a more precise sense in common parlance. It also refers to the ownership of a particular company. So if someone says she owns shares, the instinct of some people will be to answer, shares in what company? Similarly, an investor might tell his broker to buy him 100 XYZ Incorporated shares. If he said, buy 100 stocks, he would refer to a whole range of firms, actually 100 different ones. The statement, I own shares, may also cause a listener to reply even more broadly. Shares of what? What sort of investment? It should be noted that shares of many types of financial instruments may be owned: mutual funds, exchange-traded funds, limited partnerships, trusts of real estate investment, and etc. On the other hand, stocks apply only to corporate equities, shares that are exchanged on the stock exchange. Stocks. Let's just confine ourselves to stocks and financial markets. Investment practitioners also use the term stocks as synonymous, of course, with publicly traded firms. They could apply to stocks of energy, stocks of value, stocks of big or small caps, stocks of the food industry, stocks of blue chips, and so on. In each case, the stocks themselves do not apply so much to these categories as to the companies that issued them. Financial pros often refer to common stock and preferred stock. But these are not types of stock, but kinds of shares, in fact. So when individuals speak about a company's stock, they most frequently talk about their common stock. Common stock refers to a corporation's share of ownership and the type of stock in which most individuals invest. When individuals speak about stocks, they typically refer to common stocks. In fact, the vast majority of inventory is released in this form. Common shares represent a profit, a dividend argument, and confer the right to vote. Investors most commonly receive 1 vote per share to elect members of the board who oversee the management's major decisions. In contrast to preferred owners, stockholders thus have the capacity to exert power over corporate governance and management issues. Shares. The single smallest denomination of the stock of a company is a share. So if you break up stock and refer to particular features, share is the right word to use. Popular and preferred apply to various classes of the stock of a corporation. They bear various rights and privileges, and at different rates they exchange. Popular shareholders, for instance, are permitted to vote on company referendums and staff. Preferred shareholders do not have voting rights, but they have preference, on the other hand, to be compensated if the business goes bankrupt. Both kinds of shares pay dividends, but they are guaranteed by those in the chosen class. The two main types of stock shares are standard and preferred. However, it is also possible for the companies to configure various classes of stock to suit their investors' needs. Various voting privileges are granted to the various classes of shares, often simply designated as A, B, and so on. For example, a select group that receives maybe 5 votes per share will hold one class of stock, while a second class would be distributed to the majority of investors who receive only 1 vote per share. Trading mechanisms. Trading processes, whatever the type of market, apply to the logistics behind trading assets and securities. Exchanges, brokers, or OTC markets may be these markets. The processes are the actions by which an asset's buyers are matched with sellers. Two key types of trading structures are available: order-driven markets and quotes markets-driven. Trading mechanisms, quote-driven. In a quote-driven market, buyers and sellers are presented with continuous prices or quotes. Market manufacturers have these rates, which means that these types of systems are best suited to the dealer or OTC markets. For a consumer, the price offered is the price at which a dealer is willing to sell. For a seller, the price given is the price at which a dealer is prepared to purchase. Usually, the sales price quoted would be lower than the sale price. The spread is the benefit that is made by the market maker, the trader. Trading mechanisms, order-driven. Buyers and sellers of assets are able to position orders for assets they wish to buy or sell in an order-driven market. They can list at the market price, which immediately executes a market order at the best price possible. Alternatively, before those pricing conditions are met, they may list a fixed or limit price that implements either a limit or stop order, not to be executed. In an order-driven market, counterparties, depending on the listed price, are not generally available immediately, and this is so. Trading processes powered by order are more suitable for exchanges. Orders will be executed until each purchaser or seller identifies a suitable counterparty. In other terms, only if a seller who is willing to sell at the specified limit price is located can a purchase order be executed. Trading processes driven by order are also assisted by an order book. Order book. The device or database that exists behind an order-driven trading process is an order book. Both buyers and sellers are listed in the book, as well as their intended offer or asking prices. When the lowest sale order and the highest purchasing order equal or surpass each other, orders in an order-driven trading system are executed. Usually, order books will continue to refresh as new orders are added in real time. The order-driven market disadvantages. The order-driven type of trading systems would have lower liquidity than the quote-driven market. A commodity manufacturer is often readily available to sell or buy in a quote-driven market, as long as the trader is prepared to meet the slightly higher quoted price premiums. Trades will stagnate in an order-driven market if buyers are not willing to meet the prices of sellers or vice versa. Order-based market exchange systems are most suited for assets that are actively exchanged, and naturally very liquid, because of this automated matching method. These markets include, amongst others, futures, options, bonds, and some currencies. Trading mechanisms, order types. There are several different order types that a trader can take advantage of in order-driven trading systems. These have been described previously, but are described further in one of our other posts. The inclusion of the real-time order book enables traders to take advantage of pricing caps and stops that will not be reached before their terms are met. This varies from the intermediate implementation of market pricing, which can be detrimental for traders. Trading mechanisms, order timing. In addition, trading mechanisms guided by order allow traders to specify the shelf life of a particular order. For example, instructions may be held indefinitely before they're executed, set to last for a day only, or set to last for a particular duration. Chapter 7. Analysis. Stock analysis is an examination of a specific trading instrument, an investment segment, or the whole of the industry. Stock analysts try to predict an instrument, industry, or market's potential operation. Understanding stock analysis. Stock analysis is a way of making purchasing and selling decisions for investors and traders. Investors and traders seek to gain an advantage in the market by making educated choices by analyzing and reviewing past and present results. Fundamental analysis. Two fundamental forms of stock analysis are available: basic analysis and technical analysis. Fundamental research relies on source data, including financial statements, economic statistics, assets of the business, and market share. Investors and analysts usually analyze the metrics on the financial statements of a company to perform quantitative research on a public company or industry: balance sheet, income statement, cash flow statement, and footnotes. These statements are published to the public via the EDGAR database system, which is operated by the U.S. Securities and Exchange Commission as a 10Q or 10K filing in the SEC. In addition, during its quarterly earnings press release, the earnings report published by a company is evaluated by investors who aim to assess how much sales, expenditures, and income a company produces. An analyst will typically search for the calculation of the profitability, liquidity, solvency, efficacy, growth trajectory, and leverage of a company while running stock analysis on a company's financial statements. It is possible to use different ratios to assess how safe a firm is. For instance, to determine whether a business will be able to cover its short-term liabilities with its current assets available, the current ratio and rapid ratio are used. Dividing current assets by current liabilities, which can be derived from the balance sheet, determines the formula for the current ratio. Although there is no such thing as an ideal current ratio, a ratio of less than 1 will suggest to the stock analyst that the company is in poor financial health and, when due, may not be able to cover its short-term debt obligations. A stock analyst will want to know the current debt levels taken on by a company while also looking at the balance sheet. The debt ratio, which is determined by dividing total liabilities by total assets, can be used by a stock analyst in this situation. Usually, a debt ratio above 1 means that a business has more debt than cash. In this scenario, a stock analyst may assume that a rise in interest rates may increase the risk of the company going into default if the company has a high degree of debt. In order to give an investor a sense of whether the company is growing, stable, or declining, stock analysis includes contrasting the current financial statements of a company to its financial statements in the previous years. It is also possible to equate a company's financial statement to that of one or more other firms within the same sector. By looking at their income statements, a stock analyst might be looking to compare the operating profit margin of two rival firms. The operating profit margin is a statistic that indicates how much income is left after payment of operating expenses and what share of income is left to cover non-operating costs, and is measured as income divided operating income. A corporation with an operating margin of 0.30 would be more favorably looked at than one with a margin of 0.03. A 0.30 operating margin means that after operating expenses have been covered, a corporation has 30 cents left over for every dollar in sales. In other terms, to account for its contingent or fixed expenses, the business uses 70 cents out of every dollar in net sales. Technical analysis. Technical analysis is the second form of stock analysis. In order to forecast the likelihood of potential market changes, technical analysis relies on the study of past and current price behavior. The stock market as a whole is analyzed by technical analysts and is mainly concerned with price and volume, as well as with the demand and supply factors that drive the market. For technical analysts, charts are a crucial tool, as they show a graphical illustration of the trend of a stock within its stated time span. Using a map, for example, a technical analyst can mark such areas as a level of support or resistance. Support levels are characterized by previous lows below the current selling price, and resistance indicators are put above the current market price of the stock at previous highs. A break below the level of support would suggest a bearish trend for the stock analyst, while a break above the level of resistance would take on a bullish viewpoint. Only when supply and demand forces influence the analyzed price trend is technical stock analysis successful. Analyzing stocks using technical analysis cannot be effective when external factors are involved in a price movement. Examples of causes that can influence a stock price other than supply and demand include stock splits, mergers, dividend announcements, class action litigation, the death of the CEO of a corporation, a terrorist attack, accounting scandals, changes in management, changes in monetary policy, and etc. It is possible to do both fundamental and technological analysis separately or together. Some analysts, while others stick to one, use both types of analysis. Either way, an important method of designing the best investment plan for one's portfolio is to use stock analysis to vet stocks, industries, and the economy. Chapter 8. Explained. The stock market refers to public markets that exist for the issuance, acquisition, and sales of securities that trade on or over the counter on a stock exchange. Stocks, also known as equities, reflect a company's fractional ownership, and the stock market is a place where investors can purchase and sell such investable assets as ownership. An effectively operating stock market is seen as vital to economic growth, as it allows businesses the opportunity to access public capital rapidly. Stock market purposes: income of capital and expenditure. Two very significant reasons serve the stock market. The first is to provide businesses with money that they can use to finance and grow their companies. If a company issues 1 million stock shares that initially sell for $10 a share, that gives the company $10 million in capital that it can use to develop its business, minus whatever fees the company pays for an investment bank to manage the stock offering. The business avoids incurring debt and paying interest charges on that debt by selling stock shares instead of borrowing the capital necessary for expansion. The secondary aim of the stock market is to give investors the ability to share in profits of publicly listed companies, those who buy stocks. Investors will benefit in one of two ways from purchasing stocks. Some stocks pay dividends regularly, a given amount of money per share of stock that someone owns. If the stock price rises from its purchasing price, the other way investors can profit from buying stocks is by selling their stock for a profit. For example, if an investor buys shares of a company's stock at $10 a share, and the stock price eventually increases to $15 a share, by selling their shares, the investor will then realize a 50% return on their investment. Stock trading history. Though stock trading dates back to the mid-1500s in Antwerp, modern stock trading is commonly recognized as beginning in London with the trading of shares in the East India Company. The early investment trading days, the British, French, and Dutch governments issued charters to a variety of businesses in the 1600s. That included East India in the name. All goods brought back from the East were transported by sea, frequently threatened by extreme storms and pirates, including dangerous journeys. In order to minimize these dangers, ship owners had routinely sought out investors to provide collateral funding for a voyage. In return, investors earned a share of the monetary gains realized, filled with goods for sale, if the ship made it back successfully. These are the earliest cases of a limited liability company, an LLC, and many have only been kept together long enough for one ride. The East India Company. Eventually, the creation of the East India Company in London led to a new investment model, with importing companies selling stocks that effectively reflected a fractional ownership interest in the company, and thus offering investors returns on investments on the proceeds of all the trips financed by the company, rather than just one single trip. The new business model has allowed businesses to request larger per-share investments, allowing them to easily increase the size of their shipping fleets. Investing in such businesses, which were also covered by royally issued charters from competition, became very common because investors could potentially make big profits on their investments. The first shares and the first bourse. Business shares were issued on paper, allowing investors to swap shares with other investors back and forth. But before the establishment of the London Stock Exchange, the LSE, in 1773, controlled markets did not exist. While the immediate establishment of the LSE was accompanied by a considerable amount of financial chaos, exchange trading overall managed to thrive and expand in the 1800s. The beginning of the New York Stock Exchange. The New York Stock Exchange, or NYSE, established in 1792. The New York Stock Exchange quickly developed on to become the dominant stock exchange in the United States, and finally in the world, but it was not the first on U.S. soil. That distinction goes to the Philadelphia Stock Exchange, the PSC. The New York Stock Exchange accompanied a physically strategic role, situated among some of the largest banks and businesses in the world, not to mention located in a major shipping port. Initially, the exchange set up listing conditions for shares and very high fees, allowing it to rapidly become a wealthy institution itself. The changing face of global exchanges. For more than 2 centuries, the New York Stock Exchange has seen meager competition domestically, and its growth has primarily been fueled by an ever-growing American economy. The London Stock Exchange continued to dominate the European stock exchange market, but the New York Stock Exchange became home to an ever-growing number of large companies. Eventually, other major countries, such as France and Germany, established their own stock exchanges, but these were mostly seen as stepping stones for companies on their way to the London Stock Exchange or the New York Stock Exchange. The expansion of stock trading into many other markets in the late 20th century, including the NASDAQ, which became a preferred home for burgeoning technology firms and gained increased significance during the 1980s and 1990s technology sector boom. The NASDAQ originated as the first trade that existed between a network of computers and conducted trades electronically. Electronic trading has made the whole trading process more time efficient and cost-effective. New York Stock Exchange faced growing competition from the stock exchanges in Australia and Hong Kong, the financial hub of Asia, in addition to the NASDAQ in Greece. Eventually, the New York Stock Exchange merged with Euronext, which was created in 2000 by the merger of exchanges in Brussels, Amsterdam, and Paris. The first transatlantic exchange was formed by the New York Stock Exchange and Euronext merger in 2007. How to trade stocks, exchanges, and OTC. Most stocks, such as the New York Stock Exchange or the NASDAQ, are exchanged on exchanges. In order to promote the purchasing and sale of stocks by investors, stock exchanges effectively provide the marketplace. In the United States, stock exchanges are regulated by government agencies, such as the Securities and Exchange Commission, the SEC, which supervises the market to protect investors against financial manipulation and to keep the exchange market running smoothly. Although the vast majority of stocks are exchanged on exchanges, some stocks are traded over the counter, or OTC, where stock buyers and sellers typically trade through a broker or market maker who directly deals with the stock. OTC stocks are stocks which do not fulfill the minimum price or other exchange listing criteria. OTC stocks are not subject to the same public reporting requirements as stocks listed on exchanges, so it is not as straightforward to obtain accurate information from investors about the companies that sell those stocks. Usually stocks in the OTC market are much thinner than stocks exchanged on an exchange-traded basis, which means that investors frequently have to deal with large gaps between bidding and asking rates for an OTC stock. In addition, exchange-traded funds with relatively small bid-ask spreads are much more liquid. Players in the capital market: investment banks, stock brokers, and investors. In stock market trading, there are a variety of daily participants. Investment banks manage the initial public offering or IPO of stock that takes place when, by offering stock shares, a corporation first seeks to become a publicly traded company. Here's an instance of how an IPO runs. A business wishing to go public and sell shares approaches an investment bank to serve as the underwriter of the original stock offering of the company. After investigating the overall value of the company and taking into account what percentage of ownership the company wants to relinquish in the form of common securities, the investment bank manages the initial issuance of market shares in exchange for a commission, while at the same time guaranteeing the company a fixed minimum price per share. Therefore, it is in the best interests of the investment bank to ensure that all the shares offered are sold at the highest price possible. Large institutional investors, such as pension funds or mutual fund firms, most usually buy the shares offered in IPOs. As the main or original market, the IPO market is known. When a stock has been distributed in the main market, all stock trading afterwards takes place in what is known as the secondary market through the stock exchanges. The word secondary market is a little misleading, since this is the market where the vast majority of stock trading takes place on a regular basis. Stockbrokers, who may or may not even serve as financial advisors, acquire and sell stocks to their buyers, who may be either institutional investors or individual retail investors. Stock brokerage firms, mutual fund companies, hedge funds, or investment banks may employ equity research analysts. There are people who study publicly traded firms and try to predict whether the stock of a company is likely to rise or fall in price. Important stock market investors are investment managers or portfolio managers, including hedge fund managers, mutual fund managers, and exchange-traded fund executives, because they buy stock and sell vast amounts of stock. If a common mutual fund chooses to invest heavily in a specific stock, this demand for the stock alone is always sufficiently large to push the price of the stock substantially higher. Bull and bear and short-selling markets. Bull and bear markets are two of the fundamental principles of stock market trading. The term bull market is used to refer to a stock market where stock prices are normally growing. This is the sort of market in which most investors succeed, since most equity investors are buyers of stocks rather than short sellers. When stock markets typically fall in price, a bear market exists. Via short selling, investors can still benefit even in bear markets. Short selling is the practice of borrowing stock from a trading company that holds shares of the stock that the lender does not own. In the secondary market, the lender then sells the borrowed stock shares and collects the money from the selling of that stock. If the stock price falls as the investor wishes, then by buying a significant number of shares, the investor will realize a profit to return to the broker the number of shares they lent at a total price lower than what they earned earlier at a higher price for selling shares of the stock. For example, if an investor assumes that company A's stock is likely to decrease from its current price of $20 a share, the investor will put down what is known as a margin deposit in order to borrow from his broker 100 shares of the stock. He then sells each of those shares for $20, the current price, earning him $2,000. The investor will then buy 100 shares to return to his broker for just $1,000 if the stock then falls to $10 a share, leaving him with a $1,000 profit. Stock analysis, market cap, EPS, and financial ratios. Analysts and investors in the stock market can look at a number of variables to indicate the possible future trajectory of a stock, up or down in price. Here's a list of some of the stock analysis variables most often viewed. The market capitalization or market cap of a stock is the cumulative value of all the stock's outstanding securities. Typically, a higher market capitalization implies a more well-established and financially stable business. Publicly traded companies are expected to provide earnings reports on a regular basis through exchange regulatory bodies. Market observers closely watch these reports, published periodically and annually, as a clear indication of how well the business of a company is doing. Among the key factors analyzed from earnings reports are the earnings per share, or the EPS, of the company, which represents the income of the company as shared between all of its outstanding stock shares. A number of financial ratios that are meant to reflect the financial stability, profitability, and growth potential of a publicly traded business are most often analyzed by analysts and investors. A few of the main financial ratios that investors and analysts consider are the following. Price to earnings, or the P/E ratio. The ratio between the stock price of a company and its EPS. A higher P/E ratio means that investors are prepared for the company's stock to pay higher costs per share because they expect the company to expand and the stock price to increase. Debt to equity ratio. This is a basic indicator of the financial health of a company, since it indicates what percentage of debt is financed by a company's operations relative to what percentage is financed by equity investors. It is preferable to have a lower debt-to-equity ratio, suggesting primary investor support. Return on equity, or ROE ratio. The return on equity ratio is known to be a good measure of the growth potential of a company, since it indicates the net profits of the company compared to the company's total equity investment. Profit margin. There are many profit margin ratios, including operating profit margin and net profit margin, that investors should recognize. Instead of just an actual dollar profit figure, the value of looking at profit margin is that it illustrates what the percentage profitability of a business is. A business may display a profit of $2 million, for instance, but if that only translates to a profit margin of 3%, then any substantial decrease in sales may threaten the profitability of the company. Return on assets, or ROA, dividend yield, price-to-book or P/B ratio, current ratio, and the inventory turnover ratio are other widely used financial ratios. Two fundamental approaches to investing in capital markets: investing in valuation and investing in growth. There are countless stock pricing picking methods employed by analysts and investors, but virtually all of them are one type or another of the two basic stock buying strategies for investing in value or investing in growth. Value investors invest in well-established businesses that have demonstrated stable profitability for a very long time period and can deliver regular dividend revenue. Value investment is more focused on risk management than growth investment is, but when they perceive the stock price to be an undervalued bargain, value investors try to purchase stocks. Growth investors search out businesses with extraordinarily high growth prospects, expecting to gain full share price appreciation. Usually they are less concerned with dividend revenue and are more likely to risk investing in relatively young businesses. Technology stocks are also preferred by growth investors because of their high growth prospects. Chapter 9. Psychology. The dominant sentiment of stock market buyers and sellers at any point in time is market psychology. The concept is also used to describe a rapid change up or down in the markets by the financial media and analysts. Market psychology is known to be a strong force, and any concrete fundamentals or circumstances can or may not validate it. For example, if investors unexpectedly lose trust in the economy's health and decide to hold back on stock purchases, the indices that measure overall share values will drop. The price of individual stocks, irrespective of the financial results of the companies behind those stocks, would decline along with them. Understanding market psychology. Greed, anxiety, perceptions, and conditions are all factors contributing to the overall consumer psychology of the markets. The ability these states of mind to trigger periodic risk-on and risk-off in financial markets, in other words, boom and bust cycles, is well known. These changes in consumer behavior are sometimes referred to as taking hold of animal spirits. In his 1936 book, The General Theory of Work, Interest, and Income, John Maynard Keynes coined the term. He described animal spirits, writing after the Great Depression, as a spontaneous urge to act rather than inaction. Conventional financial theory is criticized as not accounting sufficiently for consumer psychology, namely the efficient market hypothesis. That is to say, it describes an environment in which all market actors function rationally and do not take account of the emotional side of the market. But market psychology, by observing the basics, can lead to an unpredictable result that cannot be anticipated. In other words, market psychology theories are at odds with the conviction that markets are fair. Forecasting market psychology. There are in general two key methods of stock picking used by analysts, and only one of them pays a great deal attention to market psychology. Fundamental analysis attempts to pick winning stocks by evaluating the financials of the business within the context of its market. Market psychology has no role in this crunching of numbers. Technical analysis focuses on patterns, trends, and other indicators that drive higher or lower prices of a stock. One of those drivers is business psychology. Hedge funds' trend-following quantitative trading strategies are an example of investment techniques that partially rely on taking advantage of changes in market psychology. To produce money, they manipulate signals. Market psychology studies. There have been research on the effect on efficiency and investment returns of business psychology. The first to challenge the traditional market theory of competitive market were economists Amos Tversky and Nobel Prize-winning psychologist Daniel Kahneman. That is, they have not embraced the notion that on the basis of publicly accessible and appropriate pricing information, people can still make reasonable decisions in the financial markets. They pioneered the field of behavioral economics by refuting the notion. In human decision-making, their theories and research concentrate on finding systematic errors that stem from cognitive biases such as loss aversion, recency bias, and anchoring. Their analysis was widely recognized and applied to techniques for saving, trading, and fund management. Chapter 10. Strategies. For many Americans, an employer-sponsored 401k is their first retirement opportunity, with one or a similar plan provided by 65% of U.S. employees. But outside of that strategy, you may still want or need to spend to create wealth. To get more interested in the stock market, here are 5 investment strategies that beginners can use. 1. Open an IRA. The next stop for every stock market strategy after an employer-sponsored retirement plan is to invest in other tax-advantaged funds, such as a conventional or Roth individual retirement portfolio. At an online broker, you can open an IRA. Many brokerages do not require a minimum account, and once you are ready to do so, you will not spend any of your money. Brokerages are pretty similar to banks these days. The big difference is that when you are ready to invest, you'll have access to the stock market through brokers. You can contribute up to $6,000 a year to an IRA, either to one account or a combination of any of these forms of IRAs, $7,000 if you are 50 or older. One has numerous tax benefits, so find out the IRA that is best for you. And if you max out an IRA for the year, you can still continue to invest in a taxable brokerage account, which is often opened by an online broker, but does not offer an IRA's tax benefits. 2. Only invest cash that you don't need in 5 years. One major downside of conventional and Roth IRAs is that if you withdraw funds before the age of 59 and a half, there can be fines and tax implications. You can take out donations at any time, but if you pull out investment earnings early, you can be penalized or taxed. Roth IRAs are more tolerant of early withdrawals. But that limitation could be okay, because like any stock market strategy, there is a crucial rule of thumb to bear in mind. Don't spend cash you'll need within 5 years. When saving, patience pays. You need to give your assets time to weather the ups and downs of the market. A taxable investment account will not penalize early withdrawals if 59 and a half seems too far away, but it will not also provide the tax benefits of an IRA or employer-sponsored account. Most brokers offer both taxable and tax-advantaged accounts. If you are already maxing out a 401k and an IRA, and you have empty cash sitting in your bank account, opening a taxable brokerage account might be the next move. Both retirement and investment accounts, however, can be extended to the following strategies. 3. Explore index funds operated in a passive way. Ideally, while holding costs down, you want to build a healthy portfolio. To do so, most investors lean on mutual funds, index funds, and exchange-traded funds. These funds pool several stocks together, balancing out the inevitable losers and winners, rather than betting on any single company stock. And these funds are based on strategies for passive management. In comparison to aggressive investment that aims to outperform the market by constantly purchasing and selling stocks, passive investing tries to only match broader market returns. And while getting an expert to pick and choose stocks for you may sound enticing, 80% of large-cap funds underperformed the S&P 500 in the 5 years leading up to December 31st, 2019. In other words, if you had invested in a low-cost index fund closely tracking the S&P 500, there would be a fair chance that you would have seen better returns than the average mutual fund. Passive investment also brings less fees, which can erode the growth of long-term investment. The typical passive managed fund has a 0.13% asset-weight ratio cost in 2019, compared to 0.66% for actively managed funds. The array of robo-advisors that automate portfolio management has sparked this cost gap, which allows these companies to charge significantly lower fees than actively managed accounts. 4. Limit active stock trades to 10% of a portfolio. Try to keep it at 10% or less of your overall investment portfolio if you want to purchase stocks. Once again, passive strategies are actively controlled by stock market strategies that aim to beat the market on a regular basis. If you're pouring all your money into one or a few businesses, you're betting on success that could easily be stopped by a single regulatory problem, a new competitor, or a catastrophe in public relations. Some stockbrokers offer educational resources and simulators that allow you to practice trading before you dive in, if you still have a strong interest in actively trading with a portion of your portfolio. Need any guidance? Check out our list of this year's top-performing stocks. 5. Use dollar-cost averaging. Active buyers are racing for low purchases and high sales, but that's easier said than done. A safer approach, experts claim, is to make new investments, a method known as dollar-cost averaging, at regular intervals. Effective investing is less about timing the market than giving the time it requires to expand a large portfolio of investments. Slow and steady usually wins the investment race, unlike the frenzied picture you might have of stock market trading. The average of dollar-cost averaging is the process of making daily market investments over time and is not mutually exclusive to the other approaches mentioned previously. Instead, it is a way of enforcing whatever technique you have selected. With dollar-cost averaging, every month you can choose to put $300 in an investment account. When you use automated features that invest for you, this disciplined strategy becomes especially effective. When the process needs virtually no supervision, it's easy to commit to a schedule. The dollar-cost averaging strategy's advantage is that it prevents the painful and ill-fated market timing strategy. Occasionally, even experienced investors feel the urge to buy when they think rates are low, only to find out, to their dismay, that they have a longer way to fall. The investor catches prices at all stages, from high to low, as investments happen in periodic increments. The average per-share cost of purchases is effectively decreased by these periodic investments. Working with DCA requires choosing 3 parameters: the total amount that needs to be invested, the time window within the investments are made, the purchase frequency, a wise choice. For most investors, dollar-cost averaging is a wise choice. It keeps you committed to saving while decreasing the risk level and the volatility impact. But the dollar-cost averaging may not be the right approach for those in a position to spend a lump sum. On average, we find that an LSI, a lump sum investment approach, has outperformed a dollar-cost average strategy approximately 2/3 of the time, according to a 2012 Vanguard report, even when findings are adjusted for the greater uncertainty of a stock-to-bond portfolio versus cash investments. But the majority of investors are unable to make a single big investment. Thus, for most, dollar-cost averaging is suitable. In addition, the dollar-cost averaging approach is an important countermeasure to human cognitive bias. Fresh and seasoned investors are similarly vulnerable to hardwired defects in judgment. For instance, loss aversion bias causes us to asymmetrically perceive the benefit or loss of a sum of money. In addition, Confirmation bias causes us to concentrate on and retain information that reinforces our long-held convictions, while ignoring conflicting information that may be important. By eliminating human frailties from the equation, dollar-cost averaging circumvents these common problems. Spontaneous, illogical conduct is avoided by normal automatic investments. If the investor is mainly concerned with minimizing downside risk and potential feelings of regret, resulting from lump sum investing immediately before a market downturn, then dollar-cost averaging may be of use, the same Vanguard study concluded. Conclusion: start your trading journey with a deep financial market education, and then read charts and look at price actions, creating strategies based on your observations. With paper trading, evaluate these techniques when reviewing outcomes and make continuous changes. Then finish the first leg of your journey with monetary risk that forces you to tackle issues of trade management and business psychology. Although stocks for many novice investors are fine, the trading aspect of this proposal is probably not. We may have gotten to this point already, but to repeat, we strongly suggest a buy and hold approach using equity mutual funds. This is exactly the opposite of stock trading, which includes commitment and a great deal of analysis. Stock traders are trying to time the market in search of low buy and high sell opportunities. Just to be clear, buying low and selling high is a target of any investor. Yet history shows us that if you hold on to a diversified investment like a mutual fund over the long term, you're likely to do that. No active trading was appropriate. When you are just starting out with a small amount of money, it is possible to invest. It's more difficult than choosing the right investment, a feat that is hard enough in itself, and you have to be mindful of the constraints you face as a new investor. To find the minimum deposit criteria and then equate the commissions with other brokers, you'll have to do your homework. Chances are, you won't be able to purchase individual stocks cost-effectively and still be diversified with a small amount of capital. You'll also have to determine which broker you want to open an account with.